Hello, everyone. Good afternoon. This is Alex Sanchez with Pension Assurance. I'm with my audit partner, John Russin. Thank you for attending our webinar. We're very excited to share this information with you this afternoon. Thank you so much for taking your time out of this afternoon to spend these 45 minutes with us. We appreciate your time. We hope that everyone out there is safe and healthy, and that you get a couple great takeaways from this presentation. So our webinar today is regarding preparing for your first plan audit. So we want to make sure that this is a fluid webinar to where you can feel free to toss out questions by sharing them through Zoom, by raising your hand, and we'll try and address all your questions as we move along here. A little bit of background on us as far as the firm itself. Pension Assurance is a single service accounting firm. So not a full-service accounting firm where we don't do corporate audits or corporate tax work. We basically 100% of our revenue source comes from auditing benefit plans. And so it's a single-service firm that is exclusively focused, and we have about 35 individuals that are dedicated to this space. We were founded in 2014. And so back in 2019, if we date back to last year, we audited 470 retirement plans constituting approximately of $6.3 billion in plan assets and over 230 participant accounts. And this year for 2020, we're tracking to about 575. What can we expect going through the material and the agenda today? Today we'll talk about when a plan audit is needed. I think it's a very important topic and it comes up very frequently. So we'll cover that and some of the exceptions to the general rule. We'll talk about selecting a plan auditor as well. The DOL audit quality study, John will talk about that. Documentation needed during the audit process. How your plan service providers can help and how we leverage service providers to help just for an efficient audit process. Common audit findings, so basically the answers to the tests and trying to figure out where the landmines are and what we typically see out there, so we'll go through that as well. And then we'll talk about the audit timeline as well and how long it should take to go from receiving an audit package and starting the audit process to finalizing it and issuing a final financial statement. So how does this happen? Who needs an independent audit and how do we get there? So on this call, I know we have some plan sponsors that have gone over that threshold and headcount that now requires them to perform the audit. We also have some service providers on the line, so wanted to go ahead and kind of just explain how we get to this process and how we get to the point to where we have to file a large plan form for the 5500. So really everything hinges on the beginning of the year participant headcount. And so that beginning of year participant headcount that lands on your Form 5500 is what causes whether you file a small plan form or a large plan form. And so the general rule of thumb is 100 participants. And so we hear that all the time. People just say, isn't it basically 100? And if you're over 100, you file a large plan. That's the general rule. There are exceptions to it. So the biggest exception is the 80-120 rule. And the 80-120 rule basically allows you to defer if you're a growing company that's between 80 and 120 based on the status of the prior year. So if you were a growing company, you filed as a small plan and you're under 120, then you can defer the audit until you hit the magic number of 121 or more. So that's the 80-120 rule, but it's based on your plan filing status from the prior year. So there are a couple examples on this slide that I wanted to point out that show two cases where you can have two Form 5500s that look the same because you've got 118 eligible at the beginning of the plan year or participants at the beginning of the plan year. But in one case, they require the audit, and in the other case, they don't. And one other major point is what defines a participant in the eyes of the DOL. And so the definition of a participant, when we talk about this, not only includes all active accounts, and at first glance you might think of active as people who are actively employed by the company, but that's another misconception. So active employees are basically active balances in the plan. So it not only includes those that are actively involved in the plan and contributing to the plan, but also those who have balances in the plan that have left the company. So if you've got employees that have left the company and still have balances in their account, those individuals would also need to be included in that number. And then as well as that, you have people who are eligible to participate on top of it, but not actually participating. So you can see how this number can ramp up very easily. We've seen instances where you've had 50 active accounts and you've got a number of people who are eligible, and along with people that have terminated the plan and still have balances in there and still require an audit. So if you're ever unsure of whether your situation, whether you need the audit or not, it's always good to get a second opinion. Talk to your service providers, talk to your TPA, talk to your advisor, run it past them, because it's important to make sure that you're filing the right form.
And this is one of the most common questions that I'm answering, and the definition of the participant is definitely a tricky subject. As Alex said, there'll be a lot of companies that might have 15 people in their plan, and they can't understand how they're in an audit situation, but it's because of the eligible count that gets added to it. I just want to drive home a couple points. It's the beginning, because I do answer this one a lot too. People want to know, hey, if we had a merger or acquisition and our headcount increased, do we need an audit that year? Well, not unless it happened on January 1st, assuming it's a calendar year plan, then no, you're not going to need it that year. So it's every January 1st, that's the measurement date, or the first day of the plan year. That's the measurement date. That's when they look at that participant count. Another thing is 100 plans is technically a large plan. 100 participants is what defines a large plan. On the health and welfare side, that all health and welfare plans, once they hit 100, they become large, and now they're kind of subject to 5,500. They're not subject to audit in 99.9% of the cases, but they are now subject to 5,500 filing. But we're going to focus on the retirement plan, which is where we focus. On the retirement plan side, at 100, they become large. And as Alex mentioned, the 8120 rule allows them to file how they filed in the previous year. Now, if it's a new plan just incepted in a year and it has 105 participants, it is subject to audit. There's no 8120 rule because there was no prior year to look back on. So keep that in mind. I know we got Cal Savers coming up for all those that are here in California. The mandate, and it's subject to employers that have more than 100 employees, and it goes into effect in June 30th. I haven't heard any changes or extensions on that mandate yet, but I know a lot of plans have been putting in place because I've had a lot of conversations on this. So keep that in mind. If there is a company employer that has 105 eligibles or over 100 eligibles, even though there might be under 120, that first plan year will be subject to audit because they will be considered large because they cannot use the 8120 rule to look back. So just a couple points that I think misconceptions floating out there is 120 is not the magic number. It's really 100, and you get to use a 120 rule if you're an existing plan. January 1st or whatever the first day of the plan year, that's the measurement date. That's the date you got to keep in mind. And then that definition of participant is a tricky concept, and it does include eligibles, even though they're not participating, and it does include terminated employees that have left an account balance. So it's an opportunity for plan sponsors and service providers to provide an opportunity to provide value to plan sponsors if there are a lot of terminated accounts that are under 5,000 or whatever the plan document states as a threshold, to clean those out and push those out into IRAs so that you can keep the participant count lower for longer. And then plan design, sometimes there's ways to design a plan so that you can kind of anticipate the low participation and in some cases defer the audit or avoid the audit for some time.
Thank you, John. Especially with COVID-19, and I think we see it on the news, the unemployment or the filings for unemployment are going up and skyrocketing during this time. So it's something to keep in mind. We may see more terminations and balances being distributed out this year. So, trying to keep that in mind where those small balances can be cleaned out as a good tip to be able to maybe defer the audit going forward. So that's something to think about. We're of the mindset that if you don't need the audit and there's a way to get away from not having to pay that extra expense, then by all means you should do it as a fiduciary responsibility for the plan and your employees. So now that we know the audit requirement exists, how do we go about selecting an auditor? Aren't they all the same, right? You have the three initials CPA behind the name. Aren't they all the same? And that's a misconception as well. So in our industry, there's many different types of CPAs and specialists out there. If you're working for a full-service firm, you're going to be auditing corporate entities, and you're doing financial statement audits, and you may be doing 401k work or retirement plan audits, but it may not always be the case. I know typically for a plan sponsor, that's their first go-to, is to go to their existing CPA and ask the questions as to whether they can handle the 401k audit. But just know that ERISA audits are very different from GAAP financial statement audits. So you want to make sure that you do hire a specialist or someone that has had the experience in performing these audits for many reasons. And we'll talk about why, but major reasons are because they're becoming more increasingly technical in nature as far as what we're doing with these plan audits, very specialized and regulated. So it's something that, we definitely would advise that you would go through that due diligence process as a fiduciary responsibility, because it is really one of the most important things as a fiduciary, that you're hiring the right service providers to surround your plan. So many CPA firms are exiting the retirement plan space, and this is something that we're seeing due to regulatory pressure. The Department of Labor performs inspections, and they audit CPA firms from time to time, and so you want to make sure that the CPA firm that you choose is passing these inspections, and that they are being peer reviewed for specifically the EBP side. So every 3 years, our firm gets peer reviewed for our work, and so it's an independent CPA that basically audits us for our ERISA practice. And so there's a letter of opinion or a peer review report that comes out, and so that's something that we would advise for you to ask for whenever you're putting the work out to bid.
And I'll say this: there have been a lot of CPAs exiting the industry. We've seen it. We've seen it's actually becoming a little bit problematic, especially based on some of the stats that are saying, based on the CalSavers mandate, a lot of those plan sponsors are going to adopt a 401k as opposed to adopt the CalSavers program, which is only going to add to the number of large plans, especially here in California. And I honestly don't know if there's enough CPAs to, qualified CPAs to do that work. So it's becoming problematic. The peer reviews have become extremely strict, and the new norm is they're looking for deficiencies and really just trying to chase people, or trying to hold people accountable. But it definitely is swinging, so much so that we're losing almost too many CPAs that could otherwise do the work. So let's talk about the Department of Labor Audit Quality Study. So this is the kind of the history of it, and we've spoken about this quite a bit. Almost never get tired of this because it's a great marketing piece, I guess, for a firm like ours that is specialized in this. And this is kind of why we started pension assurance. It's the same concept, even though the study actually came out the following year, but it reinforced everything we kind of believed and kind of understood. But this is kind of the history of the last 4 studies they released, and this is where they look at auditors' work papers, and they determine, are they following auditing guides, or the auditing standards? Are they performing sufficient work? And so based off these studies, you can see kind of an upward trend, at least over the last 3 studies. And this last one was fairly alarming. It was released in 2015, so it's been a few years now, but it's the last one we have to go on, and it was, you know, close to a 40% deficiency rate. So that's extremely high if they're looking at 10 auditor work papers and 4 of those are deficient or substandard. And this was the actual statistics that they released as far as, you know, and when they did the study, they looked at a few things, and we have a later slide that talks about some of the couple specific things that they identified as, you know, what they associated with, you know, the correlation with quality work. The number one was definitely quantity. What they found is firms that were kind of doing this part-time during the summer, or, you know, just taking on a couple of plans because it was maybe their big client, and they just wanted to service them. So that would be the 1 to 2, 3 to 5, maybe even 6 to 24. They had extremely high deficiency rates. And so you can see, you know, instead of the 40, those ones actually had 67 to 75% deficiency. So more than half of the work papers they looked at in those categories were deficient and weren't following the standards and weren't doing this sufficient level of work. And you can see the number of firms in that group. And then where they started seeing the quality pick up was 100 plan audits and above. So in those last 2 categories, it was down to 12%, which, you know, I guess was deemed to be, you know, sufficient amount of, you know, as far as deficiencies. So this kind of told us a lot of things. I mean, it kind of, you know, obviously made the point that, you know, in this case, quantity is quality. If a firm is committed in doing a volume of these, therefore they're going to have training set up, infrastructure, they're going to have the right program, staff, and teams in place to do these, you know, and stay on top of the changing regulation, which is changing all the time. I mean, we just had changes this week based off the stimulus package. So these are all things that if you're auditing a retirement plan, you need to keep current on because it's, you know, it's changing with every change in the tax code. And the other thing that I think if you sum these up, last time I remember it was somewhere approaching 7,000 or approximately 7,000 firms. I think the new stat that the Department of Labor released earlier this year was closer to 5,000. I think it was just over 5,000 firms. So we've had approximately a 2,000 firm drop off that, you know, like I said earlier, they just don't want that pressure, and they're kind of understanding that, you know, what it takes to kind of stay in compliant in this area, and it's not worth it to do 1 or 2 of these audits. So we're seeing a lot of firm drop off in this space. So why do we care about the DOL study? Well, we care for a few reasons. You know, I think going back to, you know, fiduciary responsibilities for a plan sponsor, they should hire qualified service providers, and what if it's administration, advisory work, audit work, whatever it is, you want to hire somebody who's going to actually bring value to that plan and to the participants. There's also penalties involved in these kind of situations. The DOL, they have the ability to reject. They can't really do much against the CPA community, but what they can do is they can actually go after the plan sponsors. So they can't really penalize the CPAs that are doing, you know, substandard work, but they will go after the plan sponsors and, you know, and hope that that kind of ripple effect, you know, goes into the CPA community, which it has. And, you know, their big thing is they can reject Form 5500 filings, and then they give you a pretty quick turnaround to get it fixed, and if you don't, then they get to assess penalties. So, you know, this was kind of one of those things that's like, yeah, you know, we didn't see it too often, you know, and then this last year we actually saw 2 of these 5500s get rejected. We are dealing with a pretty big volume of clients, so, you know, that's not too alarming, but it was interesting to see 2 in the same year where we actually took over the audit because the 5500 was rejected and the prior auditor work papers were rejected by the Department of Labor, and so we had to step in. So in that case, that plan sponsor had to pay for the audit twice, get it performed, and all the headache of going through that process twice. So, you know, I guess better to be on the safe side and just hire a quality auditor. So when it comes to hiring a quality auditor, which is, we'll talk more about the actual audit itself, but this is probably one of the big pieces is actually just hiring the right auditor. You know, I've had everything. I've had the 3-question RFPs. It basically said contact information and price. To RFPs that we didn't even respond to because they were, you know, 10, 15 pages long, and it was going to take 5 hours to respond to it, and it just wasn't worth the effort. So you got to strike a balance of somewhere, you know, in the arena of, you know, an efficient RFP process, or just gathering multiple proposals and, you know, looking at not only the price, which is important. I agree with that. You don't want to overpay, and especially if it's being paid out of plan assets. You don't want the participants overpaying, because that could be a fiduciary breach as well. But, you know, you want to look at the qualitative aspects too, and the commitment of the firm, and, you know, are they going to bring value to the process? Do they understand ERISA? You know, is this something that they're going to actually help you improve the processes around the plan and the internal controls around the plan? So we always say document the decision-making process, whether it's through RFP or through gathering multiple proposals and just documenting how you came up with a decision. The Department of Labor is, you know, they have made comment that they, you know, are on the lookout for people just hiring, you know, their friends or some other existing relationship without doing any kind of due diligence. They do go after those situations. So let's say you've hired your auditor, and then now you're getting into the audit. 90+% of 401k or retirement plan audits are what we call limited scope audits. And the terminology is going to change. It's going to change next year. But as of right now, it's still called a limited scope audit. Not much is going to change about it other than just really the terminology. But so what that means is, on a typical audit, the auditor will issue a unqualified opinion, and that's the best case scenario. That means everything looked fine. We looked at everything, and we issued an opinion that everything was as is presented. Limited scope audit means we didn't look at everything. And in any other forum, this would not be acceptable, and it would not be an opinion you'd want. But in ERISA Title I, the DOL provides some regulation that says that limited scopes are acceptable for 401k plans. The reason they did that is, I guess we'll talk about what the scope limitation is. It's around assets and earnings on those assets held in a qualified institution. So if your custodian, trustee, or insurance company, since those entities receive so much federal or state oversight and regulation, the Department of Labor said there's no reason to send 5,000 plus auditors out, you know, knocking on their doors, trying to get, you know, documentation on their internal controls, retesting the valuation of the same mutual fund 5,000 times. So they allowed those institutions to issue what we call a certification letter that says, you know, that the reports and the assets held in their custody are complete and accurate. And once we've got that, and then the auditor doesn't have to go in and test the valuations or the earnings on those assets. So the scope limitation is actually a pretty small piece of the audit. It's really just the valuation on the investments and the earnings, which are pretty easy tests anyways, but it changes the scope of the audit in the sense that they now become limited scope audits, and we actually disclaim an opinion. And so if you look at an auditor opinion, you'll see we have a specific scope limitation. It'll be referred to in a footnote, and you know, we talked that it's really just the earnings and the valuation on those assets. Everything else, contributions going in, distributions going out, anything participant initiated or plan sponsor initiated does get tested, and that's part of the audit. It's just that small piece that we limit the scope on.
Thank you, John. So as we dive into the audit and required documents and what the process looks like, one of the things that we like to do is leverage service providers. Just knowing that there's service providers that have documentation and information that we could populate to perform our audits, we love leveraging our service providers to help with that process. So from a financial advisor standpoint, if the financial advisor is involved in the quarterly or semi-annual or annual meetings, we would ask for meeting minutes to come from them. If they've got things like the investment policy statement, things like that, we know that there's things that the financial advisor can help us with in obtaining information. A third-party administrator or a TPA would provide things like the Form 5500. If it's an unbundled plan, they would provide the 5500. They can sometimes even provide backup to transactions if, depending on the level of involvement they have. Sometimes they can provide backup to distributions, things like that. NDT, non-discrimination test results, which is probably a process that you're going through now as a plan sponsor, maybe within the last couple of months as you're providing year-end census data. Those are things that we would be requesting from a TPA. And then the record keeper, the custodian, the company that holds the assets, they would be providing the bulk of what we call the audit package, which includes trust reports, SOC 1 or an internal control related report that we ask for as well, which we'll dive into required documents. But that when you compile the financial advisor, the TPA, and record keeping contacts and include them in that process, that covers about 80–85% of the information that we need for purposes of the audit. So it just helps streamline the process, makes it very efficient, and just lowers the load for the plan sponsor or client. So one of the things we love to do is to hold a kickoff meeting and to find out who those service providers are so we can include them in correspondence. And it helps the service provider also be more involved and understand, okay, where the audit lies at any given point, so we're all kind of on the same page. So required documents. This is a sample PBC schedule that we provide our clients for a first-year engagement. So as you can see, you've got the first section are what we call permanent documents. So these are things that typically don't change from year to year. So you've got things like the plan document, plan amendments. If the plan has been amended since the most recent restatement, we would ask for that. An IRS determination letter or opinion letter, which is distributed by the IRS to basically say that your plan qualifies as tax exempt and as a qualified plan. Then you've got meeting minutes like we talked about, summary plan description, prior financial statements if it was audited in the last year. Now I know for many of you on the line, this is the first time going through the process, so that would be an NA. And then the prior year Form 5500, which is publicly available through the DO website. So those are what we call the top 3 items are permanent file documents, I would say, and then the rest of the items would come in year in and year out. And then when you get down to the bottom of the list, you've got your non-discrimination tests. You've got a deposit schedule, which is something that I'll share a sample of what it looks like and talk about that as well. And then your copy of fidelity bond or crime policy with ERISA endorsement, making sure that the plan assets are covered through an insurance policy. Your subsequent statements, we want to make sure that we look out for things that are happening subsequent to the plan year, just to see if there's anything that should be required or disclosed that's significant that may have occurred subsequent to the plan year that we're auditing, and then a copy of the 5500 draft. This part 2 of the PBC schedule is what we called, and I referenced before, is the audit package that pretty much comes from the record keeper. And so one of the things we like to do is right out the gate is to ask for access to the record keeping platform and system. So getting auditor access to the website will allow us to be able to compile the information and get in there and really pick off what we need in order to get the audit completed. We wouldn't ask for access to full payroll to be able to make any changes on payroll. It's just merely basically just to get what we need for audit purposes, and so we would ask for auditor access to get that completed. And then the majority of what we would request from the client or plan sponsor would be payroll documentation. So we'll ask for things like the 2019 payroll registers for audits performed in 2019, some bank statements to trace out deposits and things like that. So the list gets very, very small at the client level. Sample deposit schedule. So this is a very important schedule, one of the ones that we ask from clients to compile for us. and it basically recaps all the contributions for the year. So they're broken down by pay date, and so there's a couple of reasons why we asked for this schedule. I mean, we're trying to tie out contributions and make sure it's complete and accurate, and tying it out to trust reports to make sure that what we're reporting for contributions is accurate. But then secondly, and very importantly, we're testing this and using this report and leveraging it to see what your timeliness of contribution remittances are. So we'll compare the paycheck dates in the first column with the date deposited to make sure that it's being remitted consistently. And so what ERISA is putting out there, and what's important for them, is that you're not holding employee money for too long, and they see it as basically borrowing funds from the employee, and they really get mad when that happens. So you want to make sure that you're consistent with the way you're remitting funds, employee funds, so that we've got the employee deferrals and loan repayments that really you want to make sure those are being timely deposited. And so they're looking for consistency, and we'll talk about that as we go through common audit findings. But you want to make sure you're consistent in the way those are being deposited, and this is one of the features or one of the schedules that we request in order for us to test it. Common audit findings, so answers to the tests. These are the typical things that we see out there when we're auditing plans. Some of them could be more drastic or severe than others as far as potential costs. But number one is what I alluded to before, was late contributions. So, you know, as a small plan, you have the 7-day safe harbor allowance for timeliness, where as long as you get it within 7 days, you're good. But once you file as a large plan, that goes away. So it becomes more of a subjective rule. And so what a DOL investigator can see is if they want to make sure that you're remitting based on what's, I guess, reasonably feasible. So if you've got a history of remitting funds within 3 days from the pay date, and then you've got a couple outliers, it doesn't matter, you know, if it's within 7 days or within 15 days or within, you know, 20 days, they want to make sure that you're consistent. So they could point out those 2 outliers, for instance, if you have a couple, and point those out as prohibited transactions and call them out as being late.
And let me make the comment here.
Yeah.
So consistency is what they're looking for, and they're also looking for, and the exact wording is, as soon as it can be reasonably segregated from employer general assets. So, you know, nowadays they kind of make the comment, you know, with the electronic funds transfers, and, you know, when, you know, funding payroll and funding other tax payments, those all happen pretty real time, couple business days tops. So that's kind of the rule now, is, you know, most DOL investigators will give you 3 or 4 business days is what we'll typically see, and then they're kind of looking for the outliers outside of that. So could a plan sponsor make the argument that it's reasonable that it takes them, you know, 10 business days to segregate the assets? Maybe, but, you know, you're kind of fighting an uphill battle on that one if you've got other transactions that are happening much sooner. So we always tell our clients, just have a good plan or a good process in place, good internal controls to where you can consistently remit in a couple of business days, and you should be fine.
Very good. So item number 2, not following the plan document. So we see this come out in many different ways, but the plan document is really the premise for your tax qualification. So you want to treat it as basically the Bible for the plan. You want to make sure that the way you're operating the plan is consistent with the way the plan document is written. So if whoever is administrating or operating the plan from a day-to-day standpoint, I would definitely urge you, if you haven't had a chance to read the plan document, to go through it and really understand what you have as far as the ability to do and what not to do as it relates to the 401k or retirement plan, because this is where we see when we take over audits for the first time, where we tend to see some issues. So definition of plan compensation is huge. It's something that the way that the plan document defines plan compensation, you want to make sure that the way you're calculating deferrals and contributions for employees is based on the right definition of compensation. So if you have bonuses that get paid out, can those be included, or should they be excluded from the plan based on the way the plan document is written? And that could be a costly thing if you've got deferrals that did not include bonuses, and then you have to retroactively fix that sort of thing, especially if the company is paying large amounts of bonuses. And that's not only bonuses, but any payroll code, fringe benefits, things that can feed into the calculation. You want to make sure that all those payroll codes are consistent within the payroll system with the way the plan document is written. Same goes with eligibility. You want to make sure that you're following the plan document when it comes to eligibility and that people aren't falling through the cracks there. And then vesting as well. So making sure you're following the vesting schedule in accordance with the plan. Item 3, not following participants' instructions, especially in an electronic environment now. There's different ways to manage this. Where if, let's say, me as an employee, if I wanted to go from 5% to 10%, how can I go about doing that? Is it strictly electronic where I have to go to the record keeper's website myself and make that change? And if that's the case, can that change, can it fall through the cracks, or is it consistent to where you've got the HR personnel or personnel in finance getting updated information on a weekly basis or bi-weekly basis as you're running payroll to make sure those changes are flowing through on a timely basis into payroll. So you want to make sure there's a paper trail, especially if, let's say, you have the option or you give employees the option to submit either an email or just if somebody pops into your office and says, hey, can I process this change? I want to knock down my percentage from 10% to 0 this month. Is there some sort of paper trail? Is there an email? Is there a form? And if that's the way you want to process those changes, is that information going into their personnel file? Because these are things that we'll be asking for as part of the audit, just to make sure that the contributions that are being remitted are accurate, not only at the plan level, but at the participant level as well. Missed enrollment and auto enrollment plans. So this is a feature that we think is great. It allows people to save more towards retirement. The auto enrollment feature, if you have any type of auto enroll feature in the plan, whether it's a non-elective profit sharing contribution where an employee does not have to contribute a dime to the plan but still gets a contribution, or if it's an auto enrollment where as soon as they hit a certain eligibility point, they're automatically enrolled, let's say 90 days at 3%. You want to make sure that the auto enrollment feature is working properly and that no one's falling through the cracks when it comes to that process, and then vice versa. If there's an individual who decides they don't want to contribute to the plan, is there an opt-out method or form that they're contributing or that they're providing to let you know that they don't want to contribute, and is that being processed appropriately or correctly, and is that paper trail documented somewhere? Is it in their personnel file?
For these common audit findings, the last two are numbers 2, 3, and 4. Those kind of missed contributions, whether it's due to compensation or not following participants' instructions or the auto enroll. Those can all become costly if they go on for a length of time and it becomes systematic or widespread. Those can become costly corrections. So it can all be avoided by good internal controls, good plan design and implementation on the front end. You want to capture these things before it goes on for too long. And just remember, as an auditor, we're not the police or we're not the government. We're here to help plan sponsors get their arms around their plan and get their arms around the transactions and the processes and the internal controls and improve those and make sure that the plan is running at its optimum and that it's bulletproof or at least in good shape so that when it does get selected for a DOL investigation or IRS audit, that everything's in place and it's operating correctly. So that's the purpose of the audit. It's kind of to be ready for an audit that could be, you know, more severe because of, you know, from the government where, you know, could result in penalties and other things. Well, so far I don't want to jinx this, but I think we've been pretty fortunate on the audio. I know I've been in a number of webinars this week and other video chats, and like I said, I don't want to jinx it. I shouldn't have said that. The audit timeline. I get this question a lot. How long do these audits take? And that really depends on the situation, the auditor, all the above. I mean, you know, if you think about, a lot of auditors are, you know, they're working through tax returns and corporate audits, and so it might not get started until May. And then if all hands are on deck, you know, you can get through those in a pretty timely summer. What we hear from a lot of plan sponsors and feedback just throughout is they can tend to drag on. They can tend to drag on for several months, and you do see, you know, a number of audits file, you know, between October 1st and October 15th. And, you know, some of that just happens. I mean, you know, as much as we try to avoid it, it happens to us as well because, you know, clients need to, or plan sponsors need to, you know, extend, and they need to deal with other priorities ahead of time. But, so how long does the audit take? We plan on a 6-week audit at our firm. We've done them faster than that. We've done them in 2 weeks. But a 6-week audit is pretty efficient. It doesn't put anybody under too much duress or pressure. It gives everybody time to respond, whether it's the clients, service providers, or the auditor. And this is kind of the layout that we approach it. There's some planning on the front end, some discussion, working on procedures and analytical. We do field work, which can be done remotely, and I think given our situation this year, I hope everybody's planning on doing that remotely. And fortunately, we have the technology as of, you know, the last 5+ years. So, and then the last couple of weeks are used to kind of wrap up all the open items, close out, and the audit file actually goes under through several levels of review, so that happens. So it's about a 6-week for us. It can range anywhere from a couple of weeks to a couple of months. So you want to kind of talk about that on the front end with the auditor. Here's some of those correlations with the audit quality study. They found, like we first talked about, we had a whole slide on the 100+ plans. That's kind of a big correlation. If the firm had greater than 10% of its revenue, it means they had a stronger commitment to it. Members of the AICPA Employee Benefit Plan Audit Quality Center. And then as long as the engagement partners were actually doing the continuing professional education around benefit plan audits and they were taking it seriously, those all increased, and they all had strong correlations with the quality of those audits. And this last few seconds is just, I guess, kind of our 10-second commercial, and then we'll be open for some Q&A. Just some things we do differently. We know that, you know, plan sponsors don't like to deal with new college graduates or new staff accountants that don't have the experience in auditing, let alone ERISA and 401k and all that. So that's probably a big thing we do. And we're just hyper-focused. This is all we do. Make it a priority for ourselves. So Q&A, I'll start off. Please feel free to add anything on the chat. We'll read it and we'll answer it. I know I'm getting a lot of questions right now about COVID-19. I know there's a lot of good information going around. I mean, the American Retirement Association, NAPA, they're all posting pretty good stuff. The stimulus bill that is just waiting for House approval, and we're almost there. That's got a couple good provisions to increase the loan amounts, and then also what they're calling a COVID response distribution or COVID relief distribution is a way to get out money kind of outside of the current method through hardship or whatever. As far as I get the question about, you know, our personal tax deadlines are, you know, in corporate, and those all got pushed back 90 days. Nothing so far on the Form 5500. As far as we know, it's still July 31st with an extension till October 15th. But I know the American Retirement Association has written a letter and sent that off to see if, you know, they're willing to do that. So, you know, there's a lot of good resources for that. And, you know, and then you think about all the intangible, all the effects that this might have, partial plan terminations for layoffs, things like that. So, you know, there's definitely, you know, this will impact how, you know, how retirement plans operate. One question, will slides be available after the session? Yeah, we're happy to distribute those. This also will be uploaded. The recording will be, so you'll be able to reference it back and share it with whoever you'd like to share it with. Well, I think we're exactly at 45 minutes. So we'll go ahead and wrap it up. If anybody has any other questions, you've got another few seconds to put them on the chat, or our email addresses are right there. We're happy to be a resource, regardless of, you know, whether the plan sponsor needs an audit now or has another audit or whatever. This is all we do. This year we're auditing well over 500 plans, so we're happy just to be a resource and share our experience and information. So thank you all very much for attending the webinar. Stay safe, wash your hands, and we'll all get through this. Thank you.
Thank you.